Call the Joint Retirement Board to order at 7:05.
Take it away.
Our first item on the agenda is to approve the minutes of the special meeting on May 11th, 2020. Has everyone had a chance to go over those?
Hey, Brian, it's Carolyn. I have reviewed the minutes, and I have two changes I'd like to request. First one is under Section 1, first paragraph, third line down. Says the new 2019 MC19 mortality tables. I think that should be changed to MP as in Paul rather than C as in Carolyn.
Correct.
And secondly, on the second page, getting down to the third paragraph, which begins with First Selectwoman Brenda Kubchik inquired. The third line says, Member Carolyn Trabucco stated that the board was told that new tables would be made available soon and that the actuaries were researching. I would like that to me, that reads like we were told in that December meeting that they'd be available soon, which was not what I believe I said. I believe I stated that the board had been told the new tables would be made available soon, and that was months prior to the December board meeting.
Months prior to. Got it.
I know that's semantics, but I just think that where it's placed gives the wrong impression.
So I'll change it to the board had been told months prior to the December meeting. Okay, got it.
Thank you.
I also have a correction, Eric Caliper.
Go ahead.
Oh, go ahead, Eric.
Okay, so top of page 2 where it says Eric Caliper noted that paragraph, strike the February, and it should say Board of Finance April 21 meeting. Strike the language that says fiscal impact the new mortality rates would have on the town budget, and it should say action of the JRIB in adopting the new mortality tables and the minutes of the 26th February meeting were sent.
And minutes. After the February meeting.
My email was sent after the Board of Finance meeting, after I heard the presentation from Hooker and Holcomb. There's no reason for me to send. Yes, there was no. I never sent an email after our pension meeting because that would be inappropriate to me. So.
Okay, I got that changed. Thank you, Eric.
Yep.
Are there any other changes to be made?
I have one thought, guys. It's Carolyn. At the bottom of page 2, the second to last paragraph, which comments on the comments from Mr. Walsh from the Board of Finance. He says here, the fifth line from the bottom, the line starting, taxpayers of our town during this pandemic, when 30% are seeking unemployment benefits. I don't think that, to me, that reads 30% of our town taxpayers are seeking unemployment benefits. And I don't recall that was the intent of his comment. I don't want to put words in his mouth. I just want to point that out.
Where
30% of our. So it's at the very bottom of page 2. It's under the paragraph that begins, Mr. Walsh continued commenting. And it's probably about 10 lines, 12 lines down from there. It's a subparagraph that says, will the town increase taxes to cover $1.8 million? this would be unfair to taxpayers of the town during this pandemic when 30% are seeking unemployment benefits. I don't believe he meant to infer that 30% of our town taxpayers are seeking unemployment benefits.
All right, I'll change that.
And while we're on, the paragraph above where it references me, the second sentence where it says Chairman Vahey noted that representatives, I believe that the word town belongs there. The town representatives were present at the February JREB meeting. I believe. I mean, I think that's what I said. I have to go back and listen.
Town representative.
Well, I don't know. I mean,
No, Hooker and Holcomb, I believe, was what you said.
Sorry.
That Hooker and Holcomb representatives were there.
And presented and watched the board's discussion. Okay. Thank you. Okay, well, the word representatives, then please put Hooker and Holcomb there because it sort of doesn't say representatives from. It's a little vague.
Got it.
Thank you. That's quite a few changes, and they're not like typos, so I would like to see the minutes be amended as suggested, and then be that we hold the vote next month when they've been incorporated. Because I'm sure Chris, you've got it all, but there's actually a fair amount of changes being made there, and I'd hate to see us vote on it and then have to undo something because it didn't get accurately captured. So
I'll make a motion that we table the minutes of the May 11 meeting to a date certain.
I'll second that. Carolyn?
Any discussion?
I have a discussion here. I know it's Tom Conley. We're going to change Mr. Walsh's statement about the 30%. Was it misstated by him, or should we be speaking to him about his intent on the 30%?
Yeah. So my request, Tom, is that they listen to that. They listen to it again.
Okay, good. Yeah, I just want to make sure we're reflecting his intent with that. I read it a couple of times now, and I can see the concern, but I think maybe we should either speak to him or listen to the tape. That's all. Thank you.
Yep. I'd feel more comfortable if she listens to that part of the tape again.
Sure. Me too.
Okay.
It was long, that part, but yeah, be good.
Yeah, I just don't want to change it and then have Mr. Walsh be misrepresented with it. So that's all.
No, we would not want that. So is there any further discussion? All in favor?
Aye.
Aye. Aye. Any opposed? Abstentions? So moved. Thank you.
Aye.
Chairman Vahey, this is First Selectwoman Brenda Kupchik. Could I make a request before we begin the agenda?
Yes, you may.
I was wondering if it would be all right with all the members if we moved item number 7 up to the beginning, because it looks as if it's a voting item. And I do have to jump onto a municipal leader conference call midway through, and I don't want to miss it. I was hoping that we could potentially do that item first, because I realized that the other items are long presentations. So I just wanted to request that, if that's possible.
Do we need a motion to take it out of order?
We do.
We've done this other meetings. Yeah, exactly.
Sure. You just have to have a motion to take it out of order.
Yeah, I'll second that.
So, First Selectman Kupchak is making a motion. Who's seconding it?
Tom McCarthy.
Thank you, Tom.
No problem.
All in favor?
Aye.
Aye.
Thank you very much.
So our next item then is to review and act on the actuarial services for the Joint Retirement Investment Board. So I would like to make a motion to begin the discussion that the Joint Retirement Investment Board remove Hooker and Holcomb as a provider of actuarial services and be replaced by a town RFP.
Eric Caliper, I'll second that motion for discussion.
Thank you.
So can I ask? I thought this was going to be more like a discussion about looking at RFPs to compare different actuarial services, including Hooker and Holcomb, for the pension board to review, considering they've been with the town for a very long time, and that would be typically a normal thing, just to review other actuarial services. But the motion is to actually remove them.
That's correct.
And not let them participate in the RFP process?
That's correct, Madam Selectwoman. Is there any further conversation?
Yes.
Would you what would be the basis for that?
I'm sorry, Mr. McCarthy, was that you?
I think I tripped over the First Selectman's comment, but I was just asking what would be the basis?
The basis?
Yeah, for removing Hooker and Holcomb.
All right, so the basis would be that the actuary went before the Board of Finance and misrepresented the discussions and decisions made by this body regarding the 2019 pension valuation report. That would be my reason.
Okay, so I was listening to that. That wasn't anyone's impression. They gave out a report, including both the tables, and discussed it. I'm not sure what you're saying, or why you have that impression.
You know, I don't want to dominate the conversation, so I'd appreciate if other folks on the board could give me their impression of what they saw.
It's Jack Mahoney. It was my impression that they were asked point blank in the Board of Finance meeting about the actuarial tables, and I think they even stated that they were not adopted. That was my understanding. And they were in our meeting.
Yeah.
That's not my understanding.
Did you go back?
Eric Caliper here. In the presentation that Hooker and Holcomb presented on page 13, they presented the JRIB with 5 options to choose from, and those options included changing the discount rate and accepting the new mortality tables. We discussed that at length, and we chose what we did. And that was not what was represented during the Board of Finance meeting.
Well, it was my understanding that they gave them all the things that you talked about, because typically the Board of Finance likes to review all things that were presented to any board. It wasn't my understanding that they were misrepresenting it.
So I'd like to weigh in on that for a moment. So we voted on those new mortality tables in February, and I do recognize that meeting may have not been noticed properly, But that vote and discussion, the discussion around adopting the new mortality tables and the vote relating to adopting those tables did in fact happen. And we had every intention. We didn't know that our meeting was not noticed properly. Had we known the meeting wasn't noticed properly, we would have rectified that very quickly. What I'm concerned about in hearing this is that our actuaries who work for us on the pension board didn't make it very clear that a vote was taken at the board, even if it was noticed improperly. But that vote was taken to adopt new mortality tables. And to me, a pension board that cannot trust its actuaries to represent its best interest is not an actuary that our pension board should employ.
So this is for Selectwoman Kupchik. My understanding is that Hooker and Holcomb advises your pension board on items, but it is the town's decision to decide how they fund it. So I think that they were doing their due diligence, my understanding of it, and obviously this is new, and they were telling them all the ways or giving them all the information as they're supposed to do to the Board of Finance, who makes the funding decisions for decisions made by a separate board. And I do want to know that, and for the record, that I find it highly concerning that there was a major vote scheduled on an agenda and it wasn't even listed on the agenda, and that no one from the pension board had the courtesy to call the first select woman of the town to tell her what exactly happened at that meeting, especially since it had such an incredible impact on the town. So I think there's enough sort of concern to go around. But my understanding is that Hooker and Holcomb was presenting information to the Board of Finance because they make the ultimate decision with the town on how things are funded. And their obligation is to present all information to them.
The funding, if I may continue on my thoughts first, the funding aspect is absolutely correct. That is a function of the finance capacity of our town. The recognition of the liability, it sits within the purview of the pension board. We're talking effectively about two different things. And that our actuaries not recognizing that the board had taken a vote and had every intention of recognizing the liability is separate and distinct from any discussion regarding how that liability is ultimately funded.
I would completely agree with that, but I would think that the chairman of the pension board should have been on that meeting, sharing that information. It's not really the responsibility of an actuary to tell another board what a pension board did, but to provide information as they did. I was surprised that someone from the pension board wasn't calling into that meeting.
So I think I could speak to the Jared Caliper here. I think I could speak to the historic context. Is that in the entire time that I've been on the board, is that we've always had the presentation in late winter from Hooker and Holcomb. At that meeting, we're provided options. Options could be actuary table options, discount rate options, and we always act in late winter. And we've never had a problem like this where we've had Hooker and Holcomb misrepresent the actions of the JRIB.
All right. Thank you, Mr. Caliper.
Just to be clear, Mr. Caliper, can you tell me if the pension board ever voted on an item like this?
Point of order. Mr. Brackfeld was next. Please.
Okay. Thanks, Brian. First of all, can you guys hear me? I've been going back and forth on mute, so I apologize. You guys hear me?
Sound good.
Yes.
Okay. Yes. Okay. Sorry about that. Yeah. So can I offer a suggestion that I think will allow us to move forward here? I think anytime an actuary or any provider of this sort has been with a board or the town for 20 years, it would be customary for us to be checking around, so to speak, to make sure we're still comfortable with them and that there aren't newer or better groups out there we might want to utilize. I think that we should put out an RFP, and there's no reason why H&H can't put in a proposal at that point. The pension board makes this decision. It's our decision. It should be our decision, and if we choose to go with them again, which it doesn't sound like we will, then that's okay. And if we choose a new actuary, that's okay as well. But I think we're dancing around the head of a pin here about going back in time. In fact, I was the chairman of that meeting, so if anybody's guilty of not making a call, it might be me. But I didn't think that was necessary since we had a representative of the town at the meeting. But again, I'm not here to point fingers. Does that make some sense? Is that reasonable? Or
thank you, Mr. Bradshaw.
Ken, I'm not okay with that. Oops.
Sorry, Carolyn, Madam Selectwoman was waiting.
Yep.
She's in the queue.
Sorry.
No, thank you, Chairman Behe. Yes, Mr. Brockfield, I think that that's a reasonable motion to put on the table. I think that people can have a chance to look at all RFPs and discussions can continue on before a sort of decision is made.
I'd like to get in line for the queue also. This is Caitlin.
Certainly, I think, so Carolyn, you had something to say?
Yeah, guys, the relationship between the pension board and its actuary is one of intense trust. We guide the ship using our actuary, and I'm not opposed to having them participate in the RFP, but I will tell you that I am not at all happy at the thought of them not representing our interests in front of the other town boards, irrespective of whose responsibility on the board it may or may not have been. I think we share that responsibility with our actuary. So I will defer to the larger group's opinion on this, but it makes me highly uncomfortable.
Thank you, Ms. Bossy.
Just a couple things. I just wanted to say I have been making some inquiries. There's basically two players in this field for the municipalities in the state of Connecticut, Hooker and Holcomb being one of them. The majority of the municipalities use one of two firms. I would not think it's a good idea to not have Hooker and Holcomb to be able to at least participate in responding to either the RFP or the RFQ, whatever we decide to go forward with. There are other municipalities that I've reached out to who have gone to firms outside of Connecticut, and they have regretted their decision. There's, again, two firms that are comfortable, that know the laws in Connecticut. So I wouldn't feel comfortable telling one of the two major players in the state that they can't respond to either an RFP or an RFQ. Secondly, just so you all are aware, that Hooker and Holcomb is still now working on a revised valuation report that develops the AID Act based on these new mortality tables. So they aren't even done completing their services, so I wouldn't recommend any change in their service at this point as well. In looking at a few, there's about 6 different towns that I reached out to just in Fairfield County. 5 out of the 6 are using either these two firms. So again, it's the majority of the municipalities. There's basically 2 players that my auditor feels comfortable in dealing with in the financial and filling out the financial report as well. So I wouldn't feel comfortable eliminating one of the 2 major players. That's it.
Thank you, Ms. Bossy. Is there further discussion?
Well,
this
giving
is Bruce Ryan.
Hi, Ryan.
Yeah, I concur with Ken.
Sorry.
I think I'd like to say that we include them in the RFP. I don't think there's any harm or foul in doing that. We can make the decision after all is presented to us. it also will give an opportunity to compare the services of the other Connecticut actuary.
Sounds
Brian?
Other comments? Yes, who's this?
It's Ken again.
Yes, Mr. Braxton.
Yeah, no, I just I apologize. Anyway, I'm in between two calls actually right now, so I apologize terribly. I thought this was going to be later in the meeting. It's very clear that our board was very disappointed with the way this was all handled. So I'm not arguing in any way, shape, or form about who our actuary should be. But I just also don't want to spend all evening arguing about whether or not somebody can put in a bid. I mean, I can go either way on this. I don't know why we're having such a fine-tooth comb on this. Maybe I'm wrong, and if I am, I'd be happy to be educated.
Well, it's because it was my motion. If you listen to what the wording of my motion was, that we remove and replace Hooker and Holcomb. So.
Okay, I wasn't there for that.
As that stands, this discussion has revolved around that. So now we're in a RFP discussion, and Ms. Bossi brought up the fact that they're still completing work. That all has to be, that's very relevant to the motion that was made. And I'll just make a couple of clarifying remarks. I mean, I went on the record as saying that the actuary went before the Board of Finance and misrepresented the discussions and decisions made by this body regarding the 2019 pension valuation. That, for anyone who's confused by that, it's actually recorded, and they can go back to the April 21st meeting that Mr. Caliper was listening to, which I've gone back to, and it's very clear that what this body had discussed from the same written presentation and selected was not what was presented or even remotely addressed by the actuary. So when he was directly questioned, he actually said it was only briefly discussed and made no mention of a vote. To me, that is very disconcerting for any third-party provider to do something like that. So I'll just leave that there. And regarding the whole discussion about funding and process, the process is actually in the town code. The ordinance. It actually specifies why the pension board has to do this. When Mr. Trabucco said that, that the actuary works for the pension, that's correct, because we're talking about a liability, not a funding. The only people that have to deal with how much needs to be saved and paid out in the future is this pension board. That's why they use the actuary. That's why they pay for the actuary. That's why it's written that way in the ordinance. So there's nothing that actuary or this body has anything to do with the funding decision. That lies with the Board of Finance. The Board of Finance, I'm sure, hears from the actuary so they can hear the reasonings behind the number and how it's calculated or whatnot. But that is the whole reason that we go through this process. It's why we do it in February of every year, which, by the way, is that timing is all dictated, quite honestly, by when the town actually puts in front of us. But I just want to make sure that everybody's very clear about that. And as far as notifying people in the town about something that's going to be discussed, it was in the agenda, and that's why there are bodies from the town administration that sit on this board, and not just sit on this board, also chair the subcommittee, the sub-pension of this board. So I'm actually I do not appreciate being called out by name for something that's the reason the board is composed the way it is. That's why it's structured the way it is. And I shouldn't have to defend that.
To be clear, Mr. Bailey,
Brian?
that item was not on the agenda. That item was not on the agenda. It was not listed on the agenda.
the vote, but the item, I think.
Voting
was,
item, but it was not listed
right.
as a voting item.
Right. Brian, can I get in there at some point? Mm-hmm.
Yeah, go ahead, Mr. Breckler.
I think at this point it's pretty clear that the board is not pleased with H&H. So I think it's fine for us to move on and pick a new actuary. The only question I would ask again of Ms. Bossy is the issue, and Brian, you just raised it, of them still being involved in preparing work for us. So does that affect how we time this motion and vote?
I would like to amend my motion.
Okay.
I'd like to amend my motion.
So can I just jump in if you're going to amend it? Okay.
I'd like to amend my motion that instead of replace to remove and replace, that the new motion is to conduct an immediate RFP for actuarial services for the Joint Retirement Investment Board.
You need a second for that?
I believe I do.
I'll second that.
Now, open for further discussion.
Brian, this is Tom. My 2 cents here is that it would be a mistake to exclude Hooker and Holcomb from RFP if for no other reason. I think competition will bring the town a better deal, and maybe it'll bring to light the mistakes they made, and they'll fully understand the reasons for our dissatisfaction. But be that as it may, I would second what Ken's thoughts in this and Caitlin's as well, that I think they ought to be included in the RFP.
I think that's a great point, and I don't believe my motion said anything about excluding anybody.
Okay.
Right. Right. Exactly.
It was discussed. Right. Okay. I'm fine with that. Just again, that was my 2 cents.
Thank you.
So this is Tom Conley. Can I ask a quick question?
Certainly, Tom.
Has anyone asked Hooker and Holcomb what their motivation or lack of reasoning behind not mentioning it? Does anyone have any understanding of that at all? It seems like
if I could say something, it's Caitlin.
Sure.
I'm sorry. Immediately following the vote, I reached out to Stefan, which I've stated before, to really fully, and I reached out to a couple board members as well, to fully understand the impact of this vote, being a new member of this board, being new interim CFO, to understand really what does this mean? What does this mean to the funding? What does this mean to the budget? Why is it happening now in February? And it was, a large estimated variance to our budget. So I reached out to him, and he actually came down. He came down, and we talked about it. I asked him about 3 or 4 questions, and we had a plan, and it was not you need to fund it immediately. Because my questions were, what happens if this vote didn't take place because it wasn't on the agenda? What happens if this vote took place 2 months from now when the budget process was over? How would that impact? So that clearly wouldn't be an impact to the 21 budget. So we went through the different scenarios, and his recommendation, and again, I have talked to another actuary in another firm to validate this, is, and I know a couple of members of this board don't agree, but to do an experience study. Everyone says that's not going to swing the needle, but we don't know. We do one every 5 years. If it never swings the needle, why do we continue to do an experience study every 5 years? So he said, you can do that. You can phase in a mortality table. There's things that you can do because, and in this environment with this pandemic going on, the other actuaries did agree, you know what? We know municipalities can't take a $2 million hit, a $1 million hit in late February in the middle of a budget cycle, never mind knowing that COVID was going to start in 2 weeks from now. So there are methodologies to make this work. No one was saying you shouldn't do it. Yes, you should do it. Does it have to happen day one? No. From what I've talked to Hooker and Holcomb, I've talked to someone from the other firm as well. No, I have other municipalities that are phasing it in. They're taking a 6% hit this year, a 10% hit this year. They're looking at the discount rate. There was a bunch of scenarios that we went through, and that was the plan of action. So in my opinion, there wasn't a defection. There wasn't any type of, oh, my God, it was, we have a plan. Let's move forward. We know we should adopt this. It's the right thing to do. And how do we make this all work? The other actuary from the other firm, I said, how does this work for you guys? He goes, you know what we do? We get someone from the pension board. We get the Board of Finance. We get town all together. We sit down. So we're all on the same page with this, so there's no surprises. And that's what I would suggest moving forward.
Are you
Sounds
sorry,
logical.
Ms. Fossey, you done? Is that it?
No, and I'm just going to say in conclusion, I would say going forward, I think it's a great thing. We get the pension board, we get Board of Finance, we get the town, we get them all together, and we have a meeting so that there are no surprises. That would be my recommendation, and we do it early on in the budget cycle, so that we can incorporate any change, maybe the discount rate going forward or whatever it may be, so that we're all on the same page going into the budget cycle come September, October, November.
Thank you, Ms. Bossy. My only comment would be I suggest you bring up questions and concerns and misunderstandings when you have the opportunity, when the information is being presented. Is there any further discussion, or can we overvote? Hearing none. All in favor?
Aye.
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 Any opposed? Hearing none. Abstentions? So moved. Thank you. We're moving on to the next item, which is the performance flash reports with Vanguard. And Vanguard, thank you for your patience. Sorry it took a while.
Oh, that's all right. Hi, good evening, everyone. This is Brian Binkley. Can you hear me fine?
Who's got a bird?
I hear you.
Those are not my birds.
Those are my birds. I'm outside. I'm sorry. I lost. They're not my birds, but they're my birds.
Right.
Sorry, I wasn't getting reception in the house. I'll put it in my pocket.
Good evening again, everyone. Yeah, this is Brian Binkley. I'm joined on the phone with my colleague Brian Scott, who joined us on the first call, and then also my colleague Ariel Feingold. She's one of the private equity strategists at our firm, and wanted to have her join since that was a topic of conversation at our last meeting. So as far as what we were hoping to cover this evening's meeting is I was going to spend just a little time on the performance update because I really wanted to focus on the two outstanding items from last month. Last month, just as a recap, we generally agreed on the asset allocation policy. At that time, we decided or agreed upon moving out of the two hedge funds as well as the commodity strategy. And that led us to tonight's discussion, really what dictated having a discussion around the public and the private part of the portfolio. So actually getting into the fund selection. And there was two parts from that, and they're not separate and distinct, but the two follow-ups from the meeting is to review a passive equity portfolio as well as an equity portfolio that include some active, weigh the pros and cons of both, and move forward with the decision. And the second was to have a discussion around private equity, and there was two parts. There was a request at the last meeting to share some data from other public funds on how they invest in private equity, and then also to review the Vanguard's private equity fund, which has been mentioned in the past, but we haven't discussed in any great detail. Just take any kind of comments or questions or how that agenda is to the committee. If there's anything else I missed and you want to address.
No, that sounds appropriate. So you have just an overview of the performance, and so you said to address private equity questions that were raised, and then step into asset allocation decisions. Right?
Yes.
Correct. That sounds good to me. Is there anybody
Okay.
on the board that we should be doing more or less?
Hey, Brian and/or other Brian, it's Caitlin. Did I hear that we were going to be taking a vote? Because again, that's not on the agenda. So I just wanted to caution against it.
Yeah, I'm not sure how the committee.
You know what? Here's how we handle that. If we have to take a vote, we have enough members here, we can add it to the agenda with a 2/3 vote. So I think it'll be okay.
Okay.
Well, it's for Selectwoman Kupchik. I just want to mention that in the effort of transparency to the public, it's fine if the whole entire board votes to do that, but the public's not aware of it. And so, people need to know when votes are taking place, not just the members of the board,
So,
but
Madam
also the public at large.
We're talking about asset allocations. I mean, we're actually just choosing it. I don't think we have to. That's fine. And I don't know if we need to rewrite Robert's Rules of Order. That's just the nature of this body and things that come before it. And if the public is upset that we take a 40% slug of domestic equities with a passive thing versus a 20% active, I guess we'll have to deal with the ramifications. But this is how we. I mean, I realize you haven't attended many meetings, so you wouldn't know how they take place. But
no, I don't, and I didn't get an on board as well. But I served in the legislature for 9 years, 6 years on the board and on the RTM, and we always listed any votes for the public, regardless of how unimportant they seem to the public. It's just a transparency issue, and it's just good public policy.
And that's what we try to do. And maybe we can discuss the emails that I sent you to onboard you on December 11th at the first meeting that you attended and you disregarded. But that's for another time, perhaps. I just want to get it on the record.
This is Eric Newman. That's why we could always do it as new business. Any board, any pension board has the purview of making allocations and reallocating based on their meetings, based on new information, based on market changes. First, on new presentation. We get a presentation for an investor, for a new investment. We could vote, yes, we're going to do this or we're not. How we're going to get the money. We're going to reallocate. So I am for, any vote to reallocate assets and not have to have a public notice saying to the public that we're suddenly shifting our portfolio. This is unheard. You never do that. We're going to have front runners. You're big enough. We're a small community, right? You're a bigger pension fund, and you're a public pension fund. You start disclosing your activity, you're going to be at, everybody's, smart money, institutional money will be there before you to do a position. So you don't do that. We're at the meeting. People know about the meeting. If they want to, it's not public comment. This is the board makes these decisions, not the public.
That's actually a very germane point.
I want to echo Eric's comment. Yes, no, I think Eric's exactly right. I mean, this is the nature of this board. We're working with investment allocations, investment decisions. The market is constantly moving, and the last thing we want to do is be front run because of an agenda requirement. I think Eric raised all the right points for this. Thank you for doing that.
So I'm sorry. We were in the middle of Vanguard. It sounded like that your items were very relevant, and if you could proceed with going over the performance results, we'd appreciate it.
I would, and I will, and I'm going to make the assumption, and please stop me if I don't, is that everyone has the presentation, and I'll just reference, since we're not live or anything's shared on the screen, I'm just going to say, I'm going to start us on page 4 of the presentation, so the Vanguard presentation. Does everyone have a copy? It was with me there?
Yes.
Okay. So again, I'm going to keep this section high level because, to get into really the heart of the discussion we have around the portfolio. So the good thing in the month of April, equity markets and fixed income markets did rebound. So the big difference from where we were at the end of March. What's not on this page is just a 1-month return. You're seeing different periods. But to give you context, for the month of April, U.S. stocks were up over 13%. International stocks were up over 6%. and the global or the U.S. fixed income markets were up close to 2%. And therefore, you see some of the year-to-date returns. These are calendar. These are not fiscal. These are calendar year-to-date returns. So you still see stocks are down double digits. But if it was at the end of March, instead of seeing negative 10% for U.S. stocks, you would have saw negative 20. So we did have a rebound, and as I mentioned. And just in the interest of time, I'll bring you to page 8, which has the portfolio performance of the actual town. And so looking at the 1-month performance, you'll see that the town pension plan was up 4.68% versus the target or the composite benchmark of 5.26. The reason for the underperformance versus the pension composite, you could really see from the asset allocation that is below and shows the current asset allocation versus the current policy targets and the differences. And the one point that's kind of stands out is for U.S. equities or non-U.S. equities, we were below policy target. And given the strong rebound that I just mentioned, that would explain some of the relative underperformance for just the month. And I realize it's just a month, but I wanted to give that context.
Hey, thanks, Brian. It's Carolyn Tribuco.
Brian? Oh, go ahead.
Yes. Go ahead.
Hey, so I have. Yeah, I just have a request, and I know this is going to be a little bit of added bookkeeping, but in your presentations, you have the inception date on all of our funds, and I recognize that the inception date is geared to the date that you took over kind of oversight here and as part of being the OCIO. I'd like to request you add another column somewhere here that marks the inception date of our investment into each of those funds, because it's pretty highly relevant should we decide to make a portfolio manager change. We tend to track those things over time.
And just to make sure I think I understand the comments, on page 9, for instance, we have the performance that we received, the historical performance at the total plan level, but what's not represented in the performance report is the fund performance, the individual funds. Am I right in capturing that?
Yeah, there's that, and then there's actually just the record keeping of when did, for instance, there have been funds that we've been invested in for well over a decade. And that becomes part of the narrative that we have to kind of support if a hiccup happens in the market or a manager performs in a way that is out of character with what we thought we were investing in. Sometimes we like to go back and look holistically at that relationship we had with the manager. And here you're putting kind of date 0 as March of 2020. Right.
Yes, we did note that, and it's something that I think we'll continue to work on with Callan. It's not Callan's fault. It's just making sure we represent the data correctly for the historical performance of the individual funds. So that's noted with our performance group, and thank you for bringing it up.
Thank you.
Brian, can I ask a question as well?
Of course, Ken.
Yes, please.
Yeah. And this is so awkward. I'm so sorry. It's difficult. Carolyn, you were finished?
I am finished.
Excellent. Brian, Vanguard Brian.
Yes.
We had an issue with Callan, and I don't know about you guys, but you're reporting these results gross of fees. Do you plan to be presenting us with net of fee reporting?
At the plan level or at the fund level?
Well, I mean, as much as possible, I guess, is the answer. Both, yeah.
Right.
Just the way Callan did it was they were, for technical reasons, they gave us net of fees on the quarterly reports.
Okay.
Not on the monthlies. Yeah.
Okay. All right. That's noted. Thank you for bringing that up too, Ken, to show the net performance as well.
Yeah, simply, yeah. Mm-hmm.
The net, the performance for each of the funds, the individual funds, should be net. At the total plan level, it's just showing gross right now, and then the net would be net of Vanguard's advisory fee. So,
right,
we'll look to note that.
Yeah, okay. Just so I understand that I'm being clear with you, I obviously at the end of the day, the only thing we can eat is the results net of both your fees and the fund fees. And I know there are some of these categories where it's a little more difficult, the alternatives and so forth. But it would definitely be preferable if we could see what our actual end of the day results are.
I think most of the SMAs, they give you a gross and net. It's like the mutual fund class.
Usually.
Go ahead.
I was going to say that's correct. Usually the performance of the individual funds, I'll confirm this, is shown, that we're showing you net. But to Brian's point, yes is, say if you took your American fund, Euro Pacific Growth, that 9.03% on page 9 should be net of their expenses or their fees.
Yeah, when it says gross of advisory fees, it means the Vanguard fees.
Right.
I just was wondering I found it very interesting and illuminating that you have an inception percentage, which back to 99, which predates, that's 21 years. I was just curious how you put that together. And, unfortunately this town had, I was looking at it, I was like, well, that means we got the .com crash, we had the great financial crisis, and Bernie Madoff is all embedded. I don't know if Bernie Madoff is embedded in that number, but I was kind of curious if it did, and also how you kind of pulled that number together.
Yeah, so anything at the plan level, all of the performance data really was given to us and provided to us with Callan. And so coming back to, say, the inception to date performance numbers, they go back further, January to 99, Callan had that, but they did not have the benchmark performance going prior to when they were the consultant. So they had the total plan performance, but they didn't have going back prior to where they were the consultant, but they didn't have the benchmark performance prior to when they were the consultant. And that's why it stops around that 5-year mark. And then there's no pension total target or composite target for the 10-year or the inception to date number.
Well, so
Callan
also did. Callan also did a. I don't know how. I think I know how they did it from a performance perspective. That they backed out Madoff impact. I mean, because it's a timing thing, so it depends on how you're calculating a return. So whether it's there's a couple different ways to calculate time weighted and market
money weighted, time weighted. Yes,
yeah, and there's cash flows associated with Madoff, and then the cash flows we got back from it, and I think they had both, and I'm not sure how they backed out the cash flows from Madoff, so I'm kind of curious. I know they kind of think that they're kind of done with us, but if you if we could reach back and see, I would be curious. Even if it was just an asterisk and say, look, I know it's whatever, it actually occurred. So at the end of the day, probably 4.68 is 4.68, but we always like to sort of know, with that one-off in there, because as Carolyn said before, like on inception dates and stuff, it's sort of, it can skew an opinion when you have an idiosyncratic event, like a fraud event that occurs, and it's like, oh, well, all our efforts are for naught. Well, wait a minute, that impacted the returns by 2%, or that's just sort of where I'm going with that. And then your point about, I know the weightings are slightly off. and therefore that somehow it's pointing to us underperforming the benchmark. But I would appreciate somebody going and checking. Well, one, you have a bunch of things that are zeroed out, right, which is fine because of the lag and everything.
Well, that's right.
When you throw those out and you look at the individual contributors and detractors from performance, even with the weighting being off a little bit, I don't see us underperforming in this period. So I don't have the spreadsheet in front of me, but you just look at the bigger amounts and where it underperformed, which is a small amount in hedge funds, which is actually like weighted correctly, and a piece in the fixed income, and then see the outperformance in part of the equity markets, which by significant amounts, like 100 basis points and then 60 basis points, and the dollar amount is what the dollar amount is. I don't see how you underperform by 50 basis points. It's just
right because
the math is not working.
At the fund level, you're right. There wasn't major dispersion between the individual fund managers, and so really the only other effect could be the asset allocation effect towards the performance. And given that the equity markets did so well, we were underweight the policy targets. It would make sense
I do attribution analysis, like in my prior life, and so if somebody wants to send me a spreadsheet, I'm telling you that it doesn't jive. It's not enough of an under. We're not off from target weights enough to move the dial.
Okay.
There's just
hey
30% of the market. 30% is like zeroed out of our fund. It's like 0.0, so that shouldn't do anything. And then the pieces, like I said, the pieces that underperformed were tiny, and one of them was overweight, but it wasn't much of an underperformance. And the ones that outperformed are a significant chunk. So I mean, the math should still bear. But I mean, I have someone from the spreadsheet, and I'll eat crow. I'm glad. But if you could send that to me,
hey, Brian,
I don't want to belabor it.
Brian, if I would really like to look forward toward our next allocation decision, and I would like to suggest that this information be relayed to you, Brian Vahey and Brian Vicki, so that you're able to kind of look at it with Callan, so that we are recording the correct and right and proven historical performance numbers. I mean, I have to tell you, I look at these numbers and I think, wow, we should have lowered the discount rate a long time ago. And I know with my time on this board, we made the decision not to, because the performance suggested that we were within a bound. So I'm going to ask that we sharpen our pencils and go back and really get these numbers right. But if we could please move forward to where we're going from here, I think that'd be a much better use of our time.
Good. Agree. We will make sure that it's all documented, and we did tie to Callan's number in the prior quarter, but point taken, we'll take this one offline, make sure the retirement board has all the information they need, but for the purposes tonight, we'll move on to the next discussion.
Yeah, and,
which is
Carolyn, if you look at, and I just want to point out the Mr. Bucco, if you look at page 7, it's interesting. To your point about discount rates, I mean, it's a typical. There's volatility, but I mean, there's a fair amount of double-digit returns by the fund over the past 6 years. So, and there are
and you and I forever have that tension of you being from the fixed income world and me being from the equity world. But I think we've got to go back and take another look at the historical numbers to make sure we're all comfortable with what they are.
Yeah, certainly. Great. Thanks.
Yeah, we'll be glad to help with that. And we do publish our own capital market assumptions for every asset class, and we do help plans, look at that total asset allocation and what's the possibility of hitting a particular target for your required rate of return. So I'm going to jump us to page 16. 16 reiterates what we discussed at the last meeting. So this was just to level set us where we were in discussing the broad asset allocations or sub-asset allocations to each of the buckets, what we refer to return seeking, which is the U.S. equity, international equity, and the private equity, and then the risk reducing, which is more of the fixed income, the hedge funds, which we decided on last meeting to replace, and then private real estate. So then this brought us to page 17. And so the discussion is around active and a passive portfolio. And I know there was some discussion of, Vanguard bringing us what your best thinking is. And the fact is we adopt and we implement both of these for clients. And I'll explain the trade-offs. With the passive portfolio on the left-hand side, we're just looking at two particular funds in the equity side, the Vanguard Total Stock Market Index and the Vanguard Total International Stock Market Index. So on the passive side, of course, what we're doing here, or what we're going to accomplish, is we're going to accomplish tight tracking versus a benchmark, and we're going to have a low cost. You see at the very bottom of each column, you see the weighted average expense ratio for this public equity portfolio. It's not the total portfolio. So what we give up with a passive portfolio is any potential for alpha or outperformance over a benchmark. But given that, we did talk about the last meeting, and I presented some data, is that the history will show you is that it's been very hard for equity or fixed income managers to add value over the long term. That being said, on the right-hand side is a portfolio that contains both a blend of passive as well as some active in the U.S. and international side. So a blend of 50% passive, 50% active. We find that for those plan sponsors that want to embrace active and try for outperformance, then you still have a meaningful allocation to passive, given that the persistence of outperformance from equity has been quite weak. The other thing I want to talk about on the passive equity side is there's a difference between passive and indexing. Right? Indexing is just that, following whatever your particular benchmark is. But you can have an index fund, say the S&P index fund, but you could still have made an active discussion because you concentrated all of your assets in, say, large cap and not in small cap or mid cap. And so what I'm going with is the total stock market index, and I have supporting data in the back, is investing in large cap, mid cap, small cap. You are buying the market here. And so we're not making any active tilts to style or market cap. We're just buying the entire market on the equity side with those two funds. So is there a question?
I have a question. It's Carolyn. Does the U.S. Growth Admiral and the Windsor Admiral, what's the difference between the two of them, just really quickly?
The funds, or do you mean by the Admiral?
The Admiral and the Windsor Admiral. Is one large cap, one mid cap, or one mid cap, one small cap?
Yes, they both have a large cap bias. The Windsor has a little bit more towards the mid cap space, but what's not in the name there for Windsor is that it's value. So we're equally weighting an active allocation to active on the growth side, and then value. So Windsor represents the value. Doesn't have that in its name.
How do you define value? How do you define value for that fund? Is it a dividend payer? How do you? I'd like to understand. I guess maybe we can take that offline.
Sure.
You can help me understand. My world is equities. That's where I spent my 30 years as a career, and so I'd love to appreciate better the makings of those funds.
Sure, and I can bring you to that, and we could discuss it at length, or just real quick. If you went to page 55 or 56 of the presentation, so the Windsor Fund is benchmarked to a value index, and it's representative of the two underlying managers that make up that fund. So there's two different sub-advisors, and you'll see those two different sub-advisors on page 56. One is Pzena, and they would define themselves as a deep value, whereas Wellington is the other sub-advisor you see on the page is more relative value. So each of the managers will have their own definitions of how they select or what they define as a value stock, but we're going to benchmark to a value benchmark given that their style. But each manager will have different metrics they use to select what they consider the best value stocks. Does that help?
That helps, although page 56 brings up a contrarian nature of the Wellington Fund. So the devil's always in the details. I look forward to learning about the funds in far more detail. But I do appreciate what you're saying so far.
Yes. So this is so far just centering around the decision point of, with our public equity portfolio, do we want to be active and passive? And again, helping making that decision, and why that's hard to make as the advisor is because it really reflects the risk tolerance of the broader committee. The best way to illustrate that is on page 19. And so, as I mentioned with the passive portfolio, this is just looking at rolling one-year excess returns. So as you'd expect with the passive portfolio, it's going to track the benchmark. The green line, which is the active portfolio, which I just showed, gives you the potential for alpha, or shouldn't use fancy terms, just for excess return. But it comes with periods of outperformance, but just as much as underperformance. So it's really a question to the committee of how do you feel about sticking with and staying with the course of periods of underperformance and having more tracking error or volatility against your public equity benchmark. And really, I would use that as a framework for helping guide the decision. The particular funds that we've chosen that reflected in the portfolio on page 17, reflect Vanguard's best thinking of the managers and the combination of managers.
Brian, can I chime in with a question? It's Ken.
Yes, of course.
Okay, thanks. So my preference for passive in these public markets is well known to the rest of the board. So I'll preface my comments with that. Could you speak to not necessarily these two funds that you're showing us, but to passive versus active, and if you can, including survivorship bias, what the actual results of active versus passive is. And I think it's important to look at it over longer periods because we're a pension fund with a 10, 20, 30, 40-year horizon, right? So we're not really interested in whether we can pick some fund that had a good two-year track record. I mean, I could get a monkey, obviously, to just do that. So, and you guys are a lot smarter than that. So, my understanding is if you include survivorship bias, well over 90%, probably close to 95% of active funds don't outperform their benchmarks over, say, a 10-year or, God, even 20-year period. Would you be able to confirm? I mean, if any firm knows that, it's Vanguard.
I can confirm it, and it was included, and we did discuss it briefly at the last meeting. I just didn't include that same slide here for the fear of repeating myself.
Yeah.
And so,
I
can give you those numbers.
I appreciate that. Please.
Just for reference, from last month's presentation, it was page 20 of the presentation, and this was using data from S&P, Standard & Poor's. We have our own studies that have come to the same conclusion, and that does account for survivorship bias. And so I'll cite you a number over the long term. So for all large cap equity funds, the benchmark, the index, outperformed 90% of active managed funds over a 15-year time frame. That trend is the same across different asset classes. So if you went to small cap and you went to small cap core funds, the benchmark outperformed 92%, or of the small cap funds over a 15-year time frame. International funds, 90% of active funds lag the benchmark over a 15-year time period. So the data overwhelmingly shows that over long periods of time, that the benchmark is very tough to beat.
So if I could just continue. So, we have a fiduciary duty as well as you, right? You're our co-fiduciary to make at least our best possible decisions, right? Nobody has all the answers. I don't know any phase of my life where I would choose to make a selection where I have a 1 in 10 chance of something working, when I can also make a choice where I know 9 out of 10 chance it will work. And I think I'm reflecting that accurately. It's like, getting an operation. I don't know if a doctor said you could do operation A and it has a 90% chance of being successful, or you could do operation B and has a 10% chance of being successful. I hope nobody on our board would choose option B. So my only question to you, and it's an actual serious question, is when you sit in on the meetings with your other clients, why would any institutional investing board choose an option that has a 10% chance of success versus the easy choice that has a 90% chance of success?
Yeah. Well, to answer that in seriousness is in some cases.
Yeah, I mean, it's a ridiculous question, I know, but
well, sometimes the answer is in the data too. And if you just look at the fund flows from active to passive over the, let's call it from the crisis, the amount of money that has gone into passive has been a tremendous tidal wave. It continues to happen. Plan sponsors continue to do that for all the reasons that you cited. And this is institutional portfolios as well. So the trend in the fund flow data shows that continuing to happen because of everything that we just talked about. That doesn't mean that there's some committees or individuals that sometimes still feel like I want to have the opportunity to try to outperform my benchmark, either because I think I can, or because, you know what, I have a return hurdle of making this number 6.5%, and we need more, and so therefore let's try to get more through active management. So it's a long-winded way of saying.
But even to push back on that, that still doesn't make any sense. Obviously, if you're trying to get good results and you choose the option that has a 10% chance of success, that doesn't strike me as doing your fiduciary duty.
Yeah,
Ken, I get your point. Carolyn, I get your point. But let's keep this thing forward. Look, I'm a big believer that sometimes you have an opportunity and you see a window and there is a way to generate positive alpha over and above from active management. But I think in the nature of what we're talking about tonight, we got to press on.
Right.
Well, actually, not to interrupt, but aren't we making a decision for A versus B here?
Yeah, we really do at some point have to come to a decision on the actual path that we want to take within the equity portfolio, the public and the private. And they're not dissimilar. And so before we come to that, because yes, I do want the committee's decision point to move forward so we can start to mold the portfolio differently. I will also, because we're going to talk about private equity, just bring you to page 25. I know I'm kind of jumping out of order, but even if we do make a decision to go passive in public equities, we're going to realize that we have 5% in private equity right now. We're talking about, and we've talked about moving another additional 5% into private equity. And by default, private equity is active management. You can't buy the benchmark there. So realize that there would still be an element of, let's call it active management in your portfolio through the private equity portfolio. And that's why, I know I'm jumping around here, there's been such growth in private equity. And this chart I'm showing on page 25, that just shows you the dispersion of returns between managers in each of these asset classes, meaning what's the return of the first quartile manager versus the the fourth quartile manager. And for an asset class like bonds or equities, that dispersion, and even core real estate, which is part of our discussion as well, that dispersion of returns is very tight. It's showing there's not a lot of difference between the best and the worst. But you go to an asset class like private equity, and you see a very wide dispersion of returns. And therefore, those managers that have been in the first quartile or second quartile have been able to add much more value over a public benchmark. So I just wanted to bring that up in the discussion of thinking of the whole portfolio, even though we started our conversation on the public equity portfolio.
All right. So sorry, I just want to point out something that's I was on an earlier panel prep board, and we talked about growth. So if you were in a growth factor, which I guess is an active decision, equity, you'd be crushing it obviously in values, lagged forever. But another data point is the concentration that we're seeing, in which I don't have the numbers at my fingers, but I know the top 4 names in the S&P 500 are somewhere around 16 or 17% of the overall market cap of the market. It's kind of insane. So if you're passive, you basically own, Microsoft. We can go through the names: Apple, Amazon. It's just it's insane as far as you're getting no value of somebody to sort of adjust how things are flowing. And I'm not saying that necessarily necessitates that that's going to win the day, passive versus active, but we haven't seen concentrations like this, and there's I don't want to call it a momentum factor, but you pointed out that yes, we've seen over the past 8 years, and Vanguard's been a phenomenal beneficiary of it, that the massive move towards passive causes much of that momentum in the main names, because by definition, every dollar that gets invested in the index gets distributed by market cap. So, and I guess there's no precedent for that, because we really the passive thing wasn't a thing. So I had just said that I felt that in this type of a market, having managers that are being thoughtful about extremely heady valuations in certain names, and when I say that, those top 4 names, even if you use 2022 sort of earning estimates, you're still talking 25 plus to 30 type price to earning multiples, and it's to me that's a fool's game, because it's not like this is a small growth company. These are we haven't seen multiples like that since 1999 in that sort of a space. So how do you is there a way just to reduce? I guess is there a way to sort of just reduce that exposure to sort of that large cap bias, or it's just that's part of your nose and realize that whatever it's going to be, and we just pick it up in the private equity side, like you said, you'll underperform maybe in the publics, but the private you're going to get enough outperformance to offset the passive sort of going along for the ride in the public space. I don't know. Was my question clear? It's basically some concerns about imbalances in the market.
Brian, it's Ken. Okay. Yeah, go ahead.
Yeah, I was just going to maybe I can just jump on that, Ken. Again, from a philosophical standpoint, from an investment management standpoint, we're not looking to take any tilt or bias in the market. And so therefore, we're looking to be as global market cap weighted as we can. And that's reflected in both the passive portfolio on here and to a certain extent, but not completely on the active. On the active side, that's why we're blending both a growth manager with U.S. growth and Windsor, and also why on the international side there's a growth manager and a value, because styles, regions, market caps come in and out of favor, and timing that has been a losing game for individuals and for institutions. And so therefore we believe in owning the entire market cap and let any benefit come from security selection. We've talked about security selection. It's been hard for active managers. Doesn't mean that some can't and won't outperform, but for the majority over time it's proven very difficult. So then the only question, but someone often asks Vanguard, is why do you have so many active funds, or why do you in the active management game? And we realize that's still a preference for some investors. And so in selecting active, or when you're going to be in active management, the biggest headwind to outperforming is cost. And therefore, Vanguard is putting together funds that have a lower cost than anywhere else in the industry, since that's been the biggest headwind to outperformance. It doesn't mean even these Vanguard funds with well below market fees still don't have a hard time outperforming their benchmarks.
And Brian, can I chime in on that too?
Yes.
Okay, just no, because I just wanted, I know this is getting into the weeds, and I apologize to other board members, but this is important. You're raising a very legitimate and real concern, which, just to clarify for the board, I think you're raising the following concern, which is that since these indexes are cap weighted, the representation of the biggest companies has become very, very overweighted, to the point where a handful of stocks have a very big influence on how the indexes move. That's a concern. Now, there is a way around it. There's equal weight indexes versus cap weight. I don't know what Vanguard's position is on that. I can guess that you'd be against it.
Right.
And the other point I make, Brian, is that, and we've had this discussion ad nauseum, I apologize, but in every single market condition, up markets, down markets, sideways markets, raining, sunshine, windy, hailstorms, it doesn't matter. Passive beats active 90% of the time over time. It just turns out that the markets are too efficient and the fees are too large for any individuals to pick and choose and beat the index. And
that's right.
We hired Vanguard in part because of their expertise, and I think they're making a very strong case for actually using active, but using it in the private space, and going passive in the public space, because the results just don't bear it out. Is that a fair representation, Brian?
I think that's fair. We always want to present both of these to committee, and I know you've hired Vanguard as your CIO, and how do you work with us? And well, we want to help you weigh the decision points of active or passive, just like you would how much you should be in equity versus fixed income. But that's a joint decision, with the committee. We can't make that in a vacuum by ourselves. I mean, I think for Ken and all the other points, it's right. Passive has worked very well for a lot of our institutional investors. If you went to the active side, then these are the funds that we would put together. That's where we're taking our discretion as the outsourced chief investment officer, is that this combination of funds that we've looked at through time and feel comfortable with, and we've also, as a firm, have gone out and selected which we think are the best sub-advisors for these funds. And so that, in a way, is what's outsourced to Vanguard. But in making decisions around asset allocation or active and passive, we need that input from the committee. If it's going to be a hard way to go, I mean, if there's going to be, I know there's going to be opinions on both sides, but we do have to, take a position on this.
Can I ask you one other question, Brian?
Of course.
Yeah, I think we're going to call you Brian. Oh, God, I can't call you Brian V. Brian Vanguard. Right, Brian VG. Do you or does anybody feel that there's a possible conflict here that in the entire universe of active funds, you're bringing us Vanguard active funds? In other words, if the board for some reason wanted to have some active in the public space, obviously you know these funds well because they're your funds, but it strikes me as a little questionable. Yeah.
Yeah, no, it's a question that does come up in time, and sometimes it's just the perception given that Vanguard's name is on the particular fund. But as I flipped to some of the pages in the back, for any of our actively managed funds, and that goes for fixed income, equity, or even private equity, we're looking for the best of breed sub-advisors. So they are, those fees are going to them as well, not all to Vanguard. Now, Vanguard is getting the fee for doing all the administration and operations of handling of a large fund. And that's why we can get sub-advisors to give Vanguard prices that any individual can't go to themselves. Now, we were talking about Wellington. You can go invest in that Wellington strategy, but you won't get it at 20 basis points. So it's a long way of saying these are sub-advised by external managers that have been vetted by a manager research group. And then from the expense ratio of the funds themselves, they are below industry average, I would say, by a large degree.
It's just a question.
There's no profit motive there. As you know, Vanguard is owned by its fund shareholders. There's no public shareholders. There's no private shareholders. We are owned by you, our investors, and therefore we are always trying to do what's in the best interest for our investors and give them the best chance for success. And that's partly keeping fees low.
I
appreciate
like what you've presented. Yep. I like what you've presented to us. And even though I've spent my career in equities, I've kind of moved over toward Ken's position on this, that the markets have changed in the public equity world, and passive is a really good way to get public equity exposure at a much lower cost. And as much as I relish the challenge of looking for that needle in a haystack fund, that's not what we do here, and that's not what we should focus on here. So I like what you're presenting to us tonight, Brian, on that front.
Mm-hmm. Mm-hmm. Well, I'm glad it's of value and transparent as far as why and how we're building the portfolio.
So are there other comments? Because, I have just one other. I've pretty much been dominated by 3 board members. But I just want to say that I like the blend portfolio, but predominantly because it's, you've got index exposure and then you have some active managers that when we've picked active managers in the past, and especially over long time periods, we focused a lot on how they purported to outperform, right? Where's the value? And a lot of, matter of fact, I'd say every single manager that we ever picked, it was, avoiding downside capture, meaning they may trail during the 80% of the time the market's up by, not massive amounts, or they wouldn't have any outperformance, but by avoiding a chunk of the downside. So saying, only capturing 80% of the downside movements, that spread over time allowed them to, provide the reason for picking them, which is quite honestly, and I know Ken can't disagree with me in the fixed income space. When you outperform in fixed income, it's usually by avoiding the blow up and not by picking some fantastic bond. It's really by avoiding the ones that file for bankruptcy or have issues that drives a lot of the outperformance. So when I look at the blend, it's basically split between in the equity market between the two. And I noticed that it's you're completely saying passive in all the fixed income, right? That's, if I'm reading this correctly.
Yeah, that's correct. That was on page 20, and I did go back and forth with that. We do have active fixed income funds, but really what helped guide that was that previous slide that I showed you on page 25. That really the dispersion of returns amongst active managers is the smallest and the tightest in the fixed income market. Right, there's really little places to get outperformance unless you're taking big bets away from an index. Like if you were a bond manager and you overweighted high yield, which is not in your benchmark. So both that, including with the S&P data that shows active fixed income managers haven't had any better luck outperforming in the index either. Again, that slide was in the previous presentation, which I'm glad to forward. And I regret not putting it again in this presentation. So even there, the track record for active fixed income hasn't been that conducive.
And then I just had a question on, so when you did the blend, does that screw with the market cap?
We try to keep it as close as possible, and so with the active blend, there would be a slight bias towards large cap, given those two managers. Again, we're picking up a lot of small cap and mid cap as part of the index, and small and mid is a smaller part of the overall market. So there is a slight large cap bias, but it's not material. But I'd leave it at that. The other consideration there just was back on page 20 is if you looked at the entire portfolio, this is the weightings of just the equity portfolio. So if you go to page 20 and you look in the context of the whole portfolio, now you're looking at how much you have to individual managers. And if you start putting 3% or 4% with another active manager, the ability for that to add anything to your overall portfolio is minimal. And
Brian,
I'm just going to maybe you're saying one last point is just considering that, remembering that asset allocation is the primary driver of the returns of the portfolio, the absolute returns. And so we know that from studies that asset allocation drives over 90% of the returns from your portfolio, and that's going to be the biggest factor in trying to hit any type of estimated rate of return that we have as a plan. That's going to be the biggest driver. And manager selection can often take up a lot of the time because we're talking about managers and stocks. But just saying, trying to focus on the asset allocation as a primary driver.
And so Brian, one other question. So you don't do, you don't do like a white label thing for some of the words you say, look, if you guys want an active equity strategy, we've constructed one with managers that we select and kick out and add, whatever. Like you have discretion over that sleeve, and and people can pick that. Do you not do that at all, or it's always very specific, like it is right here, where you're basically saying these three. If you do a blend, you're getting in the international, you're getting this. We recommend the value, split of value and growth, and the total stock market. So that's how you always do it. Like you guys haven't created like
this in effect is
discretionary strategy.
In effect, this is, if I'm understanding right, a discretionary strategy, meaning Vanguard has discretion and does change the underlying sub-advisors to these funds.
Right.
When we have concerns with them.
so for the audience, for the rest of the board, on page 20, right?
Yes.
Yeah. When you look at international public equity and it says Vanguard International Value, Mr. Brackeld said, this is sort of like, a little bit of self-dealing here and that these are all Vanguard. And Mr. Brinkley said, no, because what wasn't overtly said was that Vanguard International, there isn't a team of folks sitting in Valley Forge or wherever the heck you guys are officially located.
Yes.
It's actually sub-advised by many of them Wellington. Wellington is a big part of Vanguard's up, but I mean, there could be 6 managers behind that international value institutional, and it rotates and changes. So it's sort of whether it's a mutual fund or a separate managed account that Vanguard instead monitors, like the sub-advisors that they
That's
use.
correct.
So,
we monitor the sub-advisors, and if and when there's a concern about a manager, then we will terminate that underlying manager and replace them. And that does happen with all of our funds, not frequently, because we don't believe in short-termism and realize that if you're going to be inactive, you have to be patient to give that manager to outperform over a long period of time. But we do change the underlying sub-advisors that you see in some of the pages in the appendix. And for that, yes, we don't need to go to outside, board member. Vanguard can just do that at any time.
Brian, VG, can I say something? Just two quick comments. One, Christine, if you're taking minutes, nobody said anything about self-dealing. I know Brian was being a little flippant, but I have no question whatsoever about Vanguard's integrity. So I was only discussing the brand name of the fund, right? You guys understand that.
Nope.
And the second thing I'd say is, Brian V., is that I think Carolyn made a pretty salient point, which is that we probably can get a lot more mileage out of our board's collective intellect by focusing on the areas where active management might be attainable, where performance might be attainable, which Brian VG is saying is in the private space, where there's a much bigger disparity between the good and the bad, so to speak, purveyors of the product. And also, one of the reasons we went with Vanguard is we want to reduce the very minutia kind of management of the portfolio. And if we're going to have active management in there, I think it's going to require the board to be a lot more vigilant. Whereas if we can stick with the indexes in the public markets, when we wake up in the morning and we see where the S&P 500 is, we know exactly how our funds have performed. That's a very nice thing to know, versus worrying whether or not some individual manager is deviating significantly. So I'm just saying that, it just doesn't strike me as a good use of our time, to be perfectly honest, regardless of, what somebody might or might not think.
Right.
No, that's all great points, and I don't know that if I pause long enough, I want to make sure if everybody's still alive. Are there any other? Well, this is a good.
Brian, this is Tom.
Brian,
I think
a big decision point. We're going to make a vote, and what to go like active or passive, and I just want to make sure everybody gets heard. So it sounds like Tom McCarthy's got something.
Yeah, I was just about to say, from a standpoint of risk versus reward, I can't disagree with anything Ken says. I mean, it just there's more risk I see on the active side to justify the upside.
Yeah, no, I get it, and I also. Look, asset allocation is, I could show you guys all the academic studies. It's like I think it's like 92% of all performance is dictated by how much you have in fixed income and equities. It's just
Mm-hmm.
Even in a subcategory. So if you're in a fixed income manager, like I was for many years, how you allocated across the different kinds of fixed income drove 94% of your performance.
Right.
So it's at the end of the day, you got
Brian.
That's where the big question.
Brian, this is Bruce Ryan.
Yeah.
Can I make a motion that we vote on this allocation? It's on page 20. Is that where we're headed?
I think so. I just wanted to make sure that the discussion held. Everybody else got the ability to ask questions or make any comments.
Well, we have a co-CIO here that's, picked a couple of things that look like they're more expensive than an average 3 or 4 basis point index fund. We could go into the weeds with all that for hours and look at the past performance of all these people, but if they change out the sub-advisors as time, all that's going to change very rapidly, I think. So I think we, for my money, I would say the portfolio looks good, and we should take a vote on it unless there's any uncomfortableness with what they've decided makes sense.
But
Thanks,
just
Bruce.
to clarify,
Anybody else?
Go ahead, Brian.
No, I just want to make sure that I'm very thankful that Tom and Bruce spoke up. I've got a bunch of other people out there that haven't heard anything from recently, and it's tough when it's on the conference call. It's very hard to get everybody's 2 cents, and I want to make sure that people get heard because this is it's a pretty decent decision, and so I want to weight that. And I also appreciate all the private equity stuff, and I acknowledge the dispersion of returns and stuff. But I was curious that HarborVest, we see 10-year numbers and 5-year numbers and 3-year numbers. Do we have anything beyond that? Because we had a market cycle in 2008.
I'll get a good question. That's why I have one of my colleagues here. Well, first, before I go into that, Brian, do we want to just make a decision on the active versus passive?
Yeah. Hey,
so if there's no other comment.
Ken again.
Yep.
Right. I was thinking, Brian, VG, if you agree, we could separate this into two votes. Why don't we take a vote on the active versus passive issue in the public markets, and then why don't we take up the issue of the so-called other stuff? Because I didn't know that we had already agreed 100% on the allocations to the private equity, and I think we're obviously heading there. But does that make some sense? Take a vote on the
Yeah, so
I would say to separate
Ken,
the public
for
private.
Or Bruce would like a motion.
I'd be happy to make a motion if you'd like, Brian.
Yeah, go ahead, Ken. Ken, you go ahead and make a motion.
Okay. I'd like to make a motion that we accept our OCIO's recommended passive equity portfolio for the public markets. As represented on slide, I think, let's see, that's, is that page 17,
right.
I believe? Yeah, 17. Yeah. So the left-hand side, where it says total public equity, domestic public equity and international public equity, and I guess also fixed income as well. I'm making a motion that we accept the passive recommendation from Vanguard.
I second the motion.
Who was that? Who seconded?
Tom.
Any further discussion? Okay, all in favor?
Aye.
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 Any opposed? Abstentions? Hearing none, so moved. that takes care of that. And then, so what was the other? So we were talking about.
Now we would shift
equity.
more towards thinking about, or discussing increasing. We talked about increasing the private equity and the private real estate. So I wanted to have a discussion on that. I want to just go to the committee. I know it's 8:50, and as much as we want to push forward, I just want to get, just some buy-in from you. Should we continue this discussion right now? We're glad to. We're happy to stay on the phone. Just wanted to check in with you from a time perspective.
In the respecting folks' time and that we have, and I just actually would like the whole body to know. I think that we're doing some serious moving of the furniture, so to speak, in the fund. I mean, it's in a stable place now, but we're obviously moving sort of to a slightly different setup, and that I don't expect it to happen overnight. From where I sit, I would hope that it would be done in the next few months, which, when I say that, so it's like you're basically talking about a quarter of a transition, a quarter of a calendar year. So I think you basically just made the board just made a vote for 50%. Actually, we included fixed income. We just made a vote for 30 plus. There's 80% of the fund just got decided upon. So really, we're left with the remaining 20, which is evidently it's proposed to be split between.
Brian, when will that be effective? When will that 80% take effect? Tomorrow? Next week? As soon as they can.
I can jump in here. This is Brian Binkley. Is now we can start thinking about the transition plan, and so really we can start implementing this. I would say in the month of June. There's no reason not to. I think we want to be, and we have a team that focuses on transition management. I think we want to be, and we will be, very careful as far as the money movement to make sure we're not out of the market. Recognizing the different settlements, but this part of the portfolio can start to be shifted through June. All of these investments or existing portfolios are all daily liquidity, with one exception, which is the Wellington Archipelago Fund. And that is the only fund in the existing portfolio. I'll call it more on the public side. We're not talking about the private equity or the private real estate that has quarterly liquidity. So it must be given 45 days of notice. So that is the only one that will take some time to liquidate just because of the restrictions. But all of the others have daily liquidity. So, me and my team, we can start to think about what's the prudent transition plan of selling the existing investments, buying the new ones. I'm also going to just say in the context of that discussion, and maybe jumping ahead as we think about private equity, and because I want to have ample time to discuss Vanguard's private equity fund. There was a request at the last meeting to show some data behind private equity and other public funds, and I want to make sure we cover that and not just gloss over it. But where I'm going with this is, for the Vanguard HarborVest private equity fund that we've now launched, is there is the first closing that is here in 2020, and so we do want to make a decision on that. I would say at the next meeting, but realize that we would be funding that from any public equity. So where I'm going is, if we transition the existing portfolio into the existing index funds, and we do decide at the next meeting, we want to move forward with increasing our private equity allocation into the Vanguard HarborVest fund, it's fine. We would be drawing that money from the public equity side. So just giving you some things to think about as far as, for the transition.
Brian, VG, I mean, that doesn't strike it. What you just said doesn't strike me as any kind of problem in of itself, because the index funds are daily, minute-to-minute, or daily liquidity. But I'd like to just make a comment that I personally am not comfortable this evening making any decisions on HarborVest. I have a lot of questions that I'd like to discuss with you guys. I'm sure the rest of the board does as well. That's a pretty big decision, and I just think it certainly would be worth making that the centerpiece of one of our next meetings, maybe our next meeting, in fact.
Yeah.
Well, it would be real estate and private equity, but and I'll just say I understand how, because of my background, I understand transition management, TMA, where we're moving from one manager to another. And certainly we do have a big slug right now in an ETF, which is very passive, so that should be very easy. We do have a slug in Jennison, and then obviously in the international space where you're going to have, I'm used to a discussion of transition management plan and the costs associated with it, and whether they're acting as a fiduciary or not as a fiduciary. And I don't know if you guys do that in-house or you hire an outsider to do some of the transition, but your team could think about, like I said, the ETF to the Vanguard product, that can be literally same day. Boom. There's not any disruption or friction losses, but depending on the holdings in some of those other managers' portfolios and whether you do an in-kind swap, and then I would just like to to know how it would be phased in. That was a great question by Bruce, because we've been through this. I don't know if Bruce is on the board, but we've certainly moved stuff and actually Bruce's background, he understands transition stuff too. It's not just like selling your mutual fund shares and buying new mutual fund shares that night. Right.
Well, I think as Ken pointed out, Brian, you're right. And as Ken pointed out, all the stuff that's liquid on a daily basis, the transition should be seamless. It's anything like private equity where there might be, as you pointed out, holding periods, quarterly liquidation.
But it's not, Bruce. Bruce, we got some SMAs, so you have separately managed accounts. So you can actually suffer, not intentionally, but you could be selling lots on a. If we can do an in-kind, like sell from whatever. It's a transition management plan. There are 3 providers. I'm not going to say they're fantastic at it. I think Vanguard. I mean, I worked on a desk where we've done it ourselves for clients in the fixed income space. I don't know how Vanguard does it. I know Callan would always use, right? They don't manage money, so they had to use, whether it was Boney or State Street or who am I forgetting? I think Chase does
Northern Trust,
Northern Trust would be another one. Mostly like the custodian folks do it. So all I'm asking for is a bit of a plan, and parts of it might be simple. Like, hey, this chunk, we're just going to do it. Bang. We don't believe there's any stuff. This one, we looked at the portfolio and and the structure. It's in a separately managed account or in a CI, where it's in the CIT. We think whatever. It's not worth paying somebody to do it on a fiduciary basis, which might cost. But for everybody who's
fees for that, right?
Conversation or wasn't around, when you hire somebody to move your stuff from point A to point B, you can crazy enough, you can hire them on a sort of a don't want to say contingency basis, but they get paid a little bit on all the transactions, and that's how they make their money. Or you can say, no, I want you to do it as a fiduciary where they're concentrated on making sure that we lose the least amount of money in the transition, but you just sort of pay up front for it. I mean, Vanguard has no CIO, knows the players, knows the stuff that's involved, and say, look, it's not worth 4 basis points or 3 basis points to move from X to Y. That's all I'm asking for, is just a little quick snapshot to say,
yes,
how it's going to happen. And to Bruce's point, it's going to happen during this month, and we'll phase it in so that, we're not moving things or doing stuff in a bad time. And and I think that conversation shouldn't take very long at all, because we're just like, okay, great. So we know that when we come back in July, boom, we're going to be wearing a new pair of shoes, so to speak.
Yeah,
and,
we will definitely lay that out to you. When I say you, whether that's a subcommittee or the entire committee, however best to handle. But yes, we'll document and discuss that before implementing anything, given all the considerations that we just discussed.
Yeah,
and yes, I think it's
income is actually where it might be even more relevant, because actually those positions are a little less. that actually might be the harder part. I was talking on the equity side, but the fixed income might actually be the more of a bugaboo. But I appreciate that, and it could be the whole board. It shouldn't. We're not experts in TMA, and we would take whatever seems like it's prudent.
Right.
We just want to kind of be aware of it.
Yeah, and then I agree making the next meeting. We want to make sure you fully understand, everything about the private equity offer. And, given the time and that we spent tonight, it's probably best for a separate discussion.
And
so
with
we
that,
can do that for the next meeting.
Or is it in here? Did you do the cash flow? Like how the? Sorry, I haven't gone through this whole thing.
We did. My colleague Ariel, who's on the phone, is that we've looked at the existing private equity investments, and Ariel, if you want to jump in, and we've started to model those out, and those on page 37 and 38 of the presentation, where we're looking at your legacy investments and what new investments would be and how we get to that, and that's all part of the modeling that we would do for Fairfield.
The phase in. Good.
I think just
Thanks.
one.
That's great.
Ariel on the phone. Just one additional point of contact is so that you can see the legacy PE shown here and the multiple different vintages and how to scale up to a target allocation if you're interested in this product. But I think what's important is there are some dates, and we can do the best we can to communicate those to you so that we can have this conversation in reasonable time for execution of onboarding, should you want to commit to the product, where we'll have a first closing date and probably 2 to 3 or 1 to 2. It could even be subsequent closings before the first fund closes. And we just want to be as transparent as possible about when that decision would have to happen and when those documents would have to be executed in order for all of those transition aspects you talked about to allow you to get into the product. And we just don't want you to miss that timing for any other idiosyncratic reason with meetings. So I just, I'll leave it to Brian to make sure that those dates get communicated to you. But it's one other element of PE that is unique to the asset class, that it has this kind of fixed time horizon in order to get into this fund or wait till the following.
Mm-hmm. Mm-hmm. Yeah, and I noticed from your draft here, so they plan on doing annuals.
Exactly. Yep. So the fund it'll be offered annually, and no investments have been made yet in this vintage, but it will be offered on an annual basis with kind of finite subscription periods. Exactly.
Interesting. Great.
And I got a question. It's a strategic partnership with your firm, and started like pretty recently. This is really going to be the first vintage going forward, and obviously every year there'll be a new one. How quickly are they going to actually invest that money that the funding going to be getting from the strategic partnership into the deal? Are they starting it, or close. They start investing and they keep a lot of dry powder at that point. And another question, I know the fund will be doing secondary as older vintages of the prior to the strategic partnership between the two firms. Will they be potentially be selling old, the timer in 8 years now? How are we going to sell? Because we'll sell to potentially to this new fund, or going to be invested in.
And I apologize if I think my phone is cutting out just a tiny bit. So if I misrepresent one of the questions, I'm happy to you can give me a shout and I can just share the quick answer now. Go deeper next time. But I believe the first question was around the investment pacing, and so each annual fund will have a 3-year investment period where they'll be deploying capital over 3 years. To your point on secondaries, HarborVest does play on the kind of the more traditional, both the more traditional secondary strategy where distressed LPs, imagine like another fellow LP who decided to make a strategic change or had a change in their board constitution, wanted to get out of private equity, would sell their stake. And they also play in the more complex end of the market, which is helping GPs in their determinations of extending a fund, for example. So I think the question was maybe about the cash flow profile of when those secondaries are happening, but which I can share. The fund is designed to have a cash flow profile with secondaries providing cash flow in the first 5 years of the fund life and primary really driving it for the next 5 and co-investments throughout. But I know it just cut for a minute, so that's a taste of the strategies. And if I missed something, please do let me know if I missed a question there.
Okay, thanks.
And that's a great point. If there's a list of questions that there already are before the next meeting, those can all be sent to me, Brian Binkley, and we certainly welcome that.
Excellent. So I think we're done in terms of well, actually, not totally done with Vanguard because we still have the Cfo report, and just want to make sure that there's no further cash discussion and stuff. So if moving on to the next item on the agenda is the Cfo report, and Caitlin, the floor is yours.
Okay. The month of May was, as expected, clearly the pension payments went out May 1st. We had, if you guys remember, raised some cash from Sykes for these payments. So those came in, and those payments were made successfully. We also paid the last Callan invoice that went through March 2020. So that actually was paid early May as well. And the wire was received from Allianz of approximately 18.2, and that went out to BlackRock as instructed from a previous meeting. So going back to, so that was basically the activity for the month of May. Going back to, Brian, your point right now, so there is some cash sitting, so I've reached out to both Brians, and we do have some suggestions from Vanguard as well. So like I said, that we raised about $6 million from Sykes. About 4 of that is gone. I'm just using rounding numbers. So there is approximately 1.7 left that is sitting with People's in a money market fund right now. So the thought was we probably won't need the majority of it until our July 1st pensioner payments. We've raised all of our cash for the June one as well. So the thought was to possibly, and Brian from Vanguard, you can correct me if I'm wrong, in looking to kind of rebalance where we are, the thought was to send it over to BlackRock as they need only, I think, a day or two for their liquidity needs. And basically, people look to have the money in their account about 3 to 4 days prior to the first of the month for the pensioners' payments. So we can talk about sending that over. And in addition to those funds, there is about $2.3 million sitting in OPEB. I wasn't sure if we should think about moving that or doing something with that $2 million as well. So Brian from Vanguard or Brian Behe, if you guys wanted to expand on either one of those points, feel free.
Well, we generally don't. We don't ride with cash in OPEB. So I mean,
right?
Because I don't really. So, Kayla, can you just illuminate us again on how does the money get there? Like, how do we build the cash position there?
Well, basically a couple times a year we look at, because as you know, all of the cash really comes out of the general fund for all of the retiree medical payments. But what we do at the end of the year is we true up between the general fund, the cash, because clearly we budget an amount to go over into revenue into that fund on the books. And then clearly that's where all the expenses come out as well. So depending on what the medical payments were throughout the year, there could either be a deficit or a surplus. So what we do is we true up, because we don't know that number clearly until July or August due to the payment of our Anthem bills. So that was a result of some true up. So that cash is sitting in the OPEB. And like you said, nothing really comes out of that in terms of cash, very small dollar amounts.
So you true up every how
we
often?
True up,
do you guys?
Like once or twice a year, and depending on any small cash needs and how the ending balances ended at the end of the previous year.
Yeah, because I remember with the prior CFO, we never really asked, but suddenly, you see cash in OPEB, and we would quickly sweep it out and just, by the asset allocation, we would just stick it back into the market. But I didn't really understand where it came from. So
yeah, so that's basically how that works.
So I'm staring at the agenda, not the OPEB report, but I would imagine that we either by percentage of the asset allocation, or I don't know where we're underweight or overweight, but I would imagine that we just need to put it back to get as closest to the asset allocation target percentages.
And this is Brian Binkley. I would agree. Using that cash flow to rebalance to the targets. As far as the pension plan, moving to the BlackRock fund, because it's passive and it can be handled pretty quickly, but also in light of we'll make future contributions, so it doesn't make sense to put it into an active fund right now and only need to maybe pull it out again in a month or two time for future payments. So on the pension side, the BlackRock, both because you're underweight U.S. equities and because it's the index fund, so it can get quickly invested. And then the OPEB, same thing. There, it's just all passive, so it's really just to rebalance to targets. And if you want us to take a much closer look at giving the specific dollar amount recommendations, we could do that tomorrow.
Yes, I think both. I think Caitlin would appreciate that. Yeah, that'd be great. Thank you, Caitlin. Moving back to the agenda, old business. Don't believe we have any. On new business, I apologize. I did not get it sent out to the board through Chris, but I will have it sent out tomorrow. We currently use Pomerantz to monitor our portfolio and bring litigation items to the attention of the board. where we've suffered losses and there's potential legal activity where we should just be making sure our claim gets filed or pursuing remedy. And that's worked pretty well. I don't have any complaints. We're co-lead plaintiff in a litigation with Floor, for example. But another law firm called Wolf Popper, LLP, has offered to do the same thing. And that's what I'd like to send their presentation around to everybody and then potentially have them come speak to the board briefly to answer questions primarily probably next month. But they do the exact same thing as Pomerantz, and they actually would both do it. It doesn't cost us anything. So the benefit you get from where I sit is if you only have one law firm doing something for you and you're really only getting their opinion and their color, and Wolf Popper and Pomerantz are sort of two different beasts. Pomerantz is the 800-pound gorilla, and Wolf Popper used to be an 800-pound gorilla, but now they're more like a 400-pound gorilla. But the point being is anything you get from one law firm, you can put in front of the other law firm because they're looking at stuff for you, and you just get another point of view, whereas we really don't have the resources as a town to be paying some external counsel to opine on things. So it's kind of nice to have two or more law firms doing the exact same thing because you're just going to get more color and feedback and potentially have less stuff get missed as far as pending litigation that we should be filing a claim for example, and getting that sort of stuff done. So I'll send the presentation to you guys. So it's actually pretty informative about how they do things. And I would say that Pomerantz pretty much is the same thing. And we can also have Pomerantz come back and go over, what they've done. I just don't want to clog up the agenda for the next couple of months. But anyway, I'll send this along and let you guys take a look at it and put it on the agenda next month for them to literally 10 minutes to just kind of go over and answer any questions and what they do. So anybody else have any other new business items?
Hey, Brian, it's Jack. I just have a quick question on those two law firms. It's an incentive-based approach that they're taking. So how do they figure out who gets rewarded what in the event that there's a positive outcome or settlement?
That's an excellent question. Excellent question, and they can't legally. So when we sign them on to monitor our portfolio, for example, and to alert us to litigation and stuff like that, you don't sign anything when you engage them. You only engage them when they do a specific action on your behalf. So Pomerantz currently files and makes sure that our claims get filed, and they don't charge us for that. But when they did the Floor litigation, where we're a co-lead plaintiff, that's where an engagement letter gets presented to the town, and you correctly said, essentially the way we pay these people, the board would pay somebody in this sort of, because we don't funds for this, is it actually is a contingency basis. And the weird thing is, if we're doing it as a lead plaintiff of a class, whatever's agreed to as far as a fee, it's not just for Fairfield, but it's for the entire class. So anybody who participates in a class action lawsuit, because if Fairfield is the lead plaintiff, you're creating terms that the whole class is subject to. But that's a very good question, and it's addressed in here. But there's nothing up front. Like right now, to have them monitor, that's on their dime. They do it, and we're not paying for anything. There's no quid pro quo. You don't have to use them. They could bring an issue to you, and you could just go find another lawyer that would work on contingency for a better rate to do the litigation. I mean, it's just the nature of the business. They can't lock in fiduciaries to something before they even know what it is. Any other questions about the gist of portfolio monitoring from a legal perspective? If not, we can say thank you to Vanguard. We will speak next month, and as far as the reallocation of cash and stuff, we follow up tomorrow or whatnot to figure out how that's going to happen. Be appreciated, and also folks like Brian Binkley said, if there are specific questions on private equity, that prime the pump so they could have them already sort of answered or ready for our next meeting. That would be great, and I highly encourage those either to be sent directly, or you could send them to Chris and myself, and we could make sure they all get to Brian Binkley. But whatever works for folks, it doesn't matter, because those questions would come up in the course of the next meeting anyway. So please send them along, and thank you, Vanguard.
Yeah, and thank you for all the level of discussion and the questions from all the committees. So I have some takeaways, and thanks again. Have a great night.
Hey, Brian, Eric Caliper here. Just one thing.
Yeah. Yes, of course.
I'm sorry, Brian Vahey. If we could,
sorry.
I know the town has a WebEx account. I think it would be a lot easier for the facilitation of the meeting if we can use the WebEx account so members could, raise their hands and kind of see each other. I know it's been done with other board members. I think that would be highly advantageous.
I highly agree, because I don't know if Madam Selectwoman's still on. I didn't mean to shout.
Yes, I'm here.
There's no way for me to see or try and control the flow of the conversation. It's basically impossible. So, and I apologize.
Yes, you're absolutely welcome to use the WebEx. It does require a little bit of effort on our IT director's part, because he has to man them. So, but obviously, we'd be happy to accommodate the board.
Thanks.
This is Brian.
Sorry, go ahead.
I was going to say, this is Brian Vanguard. I don't know if you're allowed, but we also have technology that we could use, and I could set up a meeting, but I don't know if that wouldn't work because it has to be public, and I can't get this out to the public. But I could offer the technology to screen share and host a conference call from Vanguard side.
I appreciate it.
But you can screen share on WebEx.
Yes.
Yeah,
right. We have
just
a lot of. We have a lot of rules regarding public meetings. So Attorney Baldwin spent quite a bit of time setting this up to be in accordance with the governor's executive orders and our public meeting rules. So it is a little bit more complicated because people have to be able to call in and listen and that sort of thing.
I figured. I just wanted to make sure I offered it.
Appreciate it, Vanguard.
The other thing I'd like to offer too is that once we get to a time period where we can get all the board members together in a room, I'm sure that the Fire Training Center, with its much larger room, would be more than happy to accommodate the pension board so we can have spacing and conduct an actual face-to-face meeting too.
Good idea.
That's be a great idea, and it is so. Given the size of this board and the ability to, see people's reaction and questioning looks when stuff's being discussed and complicated. Yeah, it's just really helpful to be able to read the room or see people raise their hand. It's just I don't know. I haven't sat on any other of the public boards, but there's a fair amount of give and take with some of these issues, and it just would be great to have the WebEx, I guess. Is there any other great points? Any other new business? So we have to have a vote to go into executive session, but before I do that, I'm not sure the technology or how this if I understand it correctly, there's the ability to see who's on this conference call and to
Yes,
mute.
I have it, and Dave Kelly's on, so we can knock off whoever we need to knock off. Sorry.
All right, I'll drop off.
So we need a motion.
See you, Vanguard.
Bye.
Bye-bye. Thank you.
I'll make the motion to go into executive session. It's Carolyn.
A second, Bruce Ryan.
Okay. All in favor?
Aye.
Aye.
Aye. Aye.
Any opposed? Any opposed? Abstentions? Hearing none.
Do we,
Sorry, what? Go ahead.
I'm sorry, Chairman Behe, is the town attorney still on?
He is still on.
Okay.
Good.
He's still on.
Might the poke him
Walter
wake him
Burke,
up, but
are you
yes.
still here? Is Walter
Yes, I'm
Burke
still here.
Can you tell me the phone number because your name isn't showing up?
Sure. This is Jim Baldwin, town attorney. It's 203-257-8291.
Oh, I have you. Your name is showing up, Jim Baldwin. So we know. I'm sorry to knock you off. Or are you staying on?
Sorry.
Excellent. Mr. Cal.
Okay.
Yeah, I have a motion like to come out of an executive session, and for the record, just note that there was no votes taken during the executive session.
Anyone
Second that motion.
Who's that?
I second it. Bruce Ryan. Bruce Ryan, second.
All in favor?
Aye.
Aye.
Any opposed? Abstentions? Hearing none, so moved. That finishes our agenda for tonight. Can we get a motion to adjourn?
So motion. Tom McCarthy.
I'm sorry, who motioned?
Tom McCarthy.
So I second it, Bruce Ryan.
All right. All in favor?
Aye.
Aye.
Thank you, everyone.
Aye.
I appreciate the patience. And
Thanks.
you guys have a
Night,
great
Brian.
rest of the week. Thank
Good
you.
night, guys.
Thank you, Brian.
Good night,
Good night.
everyone.
Thank you.
Good night.